Ever feel like you just need a shortcut, to really understand something complex, but without wading through endless articles and reports? That feeling of just information overload. You should know about this stuff, but who has the time to sift through it all? Well, that's exactly what we do here on The Deep Dive. We try to cut through all that noise, pull out the really important insights, and present them in a way that gives you that genuine aha moment, a real understanding, fast. Today, we're taking a deep dive into a company you might know very well if you're in Poland, but maybe not so much outside its borders. Żabka Group S.A. Now, for anyone tracking modern retail, how consumer convenience is shifting, Żabka is a really fascinating case study. It's much, much more than just like a chain of corner shops. It really shows how a retail concept can grow into something way more sophisticated, driven by tech, and, well, incredibly impactful.
Yeah, what's truly fascinating here is just the audacity, really. How a company takes a seemingly simple idea, the convenience store, that quick stop, the forgotten milk, the impulse buy, and transforms it into this complex, tech-driven ecosystem. It's quite something. And then how that very specific, highly adapted model plays out, not just anywhere, but in a really particular and dynamic market like Poland. So for this deep dive, we've gone through quite an extensive investment analysis of Żabka Group. We're going to pull out the key threads, look at its unique business model, its, frankly, remarkably strong market position, its financial health, and critically, the risks and opportunities that really define where it might go next. Just to be clear, this isn't about giving financial advice, right?
Right.
Our mission is to give you a really comprehensive understanding of a company that has, and this is an exaggeration, fundamentally redefined convenience retail in its home market.
Okay, let's unpack this then. Our mission today, distill the most important nuggets of knowledge from all the sources we've looked at. Give you the context, the surprising facts, maybe challenge some assumptions about retail, and those key insights you need to genuinely grasp Żabka's, explosive growth and its strategic position, not just in Poland, but as a case study for Europe. We'll look at how Żabka evolved, what really makes it tick, the market forces shaping things, and what the future might hold, pulling out those critical insights you need to be properly informed. Maybe even see your local corner store a bit differently.
The convenience ecosystem more than just a store.
So when you picture a corner store, you probably think, small shop, maybe a bit basic, but Żabka has just completely changed that perception. Founded back in 1998, it started as a pretty traditional convenience chain, but they've consciously, very strategically, evolved into what their own management calls the ultimate tech-powered convenience ecosystem. And their main goal, their sort of North Star, is simple but really ambitious: make people's lives easier. And look, that isn't just marketing talk. It seems baked into their strategy. It means they're trying to solve all those little problems of modern life. Forgot your lunch, need to pick up a parcel, suddenly need a coffee. They want each store to be a seamless part of your daily routine. It's not just a shop anymore, it's a system. A finely tuned system for micro needs.
Exactly. And that transformation is built on a really sophisticated structure, much more complex than you might expect for a convenience store chain. The Żabka Group is split into three distinct but crucially interconnected units. First, the foundation is Żabka Polska. That's the core, the biggest part, the one most people see. Żabka Polska handles all the operations and commercial stuff for the retail business inside Poland. So day-to-day store management in the network is huge. We'll get to that. Plus the really intricate logistics and supply chain needed to keep thousands of stores stocked.
Okay, so that's the core Polish operation.
Then you have Żabka Future. Think of this as the group's innovation lab, the engine room for tech and new ideas. Their job is basically to speed up the development of this whole digital convenience ecosystem idea. This is where they cook up new concepts, like the autonomous cashierless Żabka Nano stores. We'll definitely talk more about those. And importantly, Żabka Future develops all the proprietary tech, the data analytics, the AI tools, everything that provides the intelligence for the whole group. They're building the brains, essentially.
The tech powerhouse.
Precisely. And finally, there's Żabka International. This division is focused purely on taking the model abroad. Their main focus right now, since they entered in 2023, is developing the store network in Romania. It's a really critical test case. Can the model work outside Poland? So you see, it's not just random growth. It's very structured, very specialized. Domestic dominance, future tech, and international expansion.
And what's really clever here is how they make money. It's not just selling, snacks and drinks. The revenue streams are incredibly diverse. It goes way beyond just product sales. I mean, sure, the main revenue is wholesaling products to their huge network of franchisees. That's the bulk of it. But they've also brilliantly turned each store into a kind of mini hub for essential services.
Yeah, that service offering is key.
Totally. Think about comprehensive services, parcel delivery and collection. I mean, how vital is that now with e-commerce booming in Poland?
Absolutely critical infrastructure.
You can also do cash deposits, withdrawals, buy lottery tickets, pay your bills, grab gift cards. This whole suite of services is just genius for creating sticky customer relationships, isn't it?
It really is.
Because the store becomes more than just a shop. It weaves itself into your daily life, saves you time. It becomes indispensable locally. And building on that, they've put a big focus on high-margin food service. Quick meals, right? Often under the Żabka Cafe brand. They're serving hot snacks, street food type things, decent coffee, directly competing with fast food places, but they're right there on your corner.
Much more accessible.
Exactly. And to boost margins and stand out, they've developed their own popular private label brands. Things like Tomsiu Paluk sandwiches, Som ready meals. These aren't just filler products. They drive profit and give people a reason to choose Żabka specifically.
And build brand loyalty, too.
For sure. And then there's their push into digital channels, just relentless. Through Żabka Future, they've made some really smart acquisitions to broaden their reach, like buying MaxFit, a big direct-to-consumer dietary meal plan company.
Tapping into that health trend.
Right. And Dietly.pl, an online marketplace for boxed meals. Again, health. Convenience. Plus, they've launched super fast e-grocery delivery with Juice and Delio. We're talking like 15-minute delivery sometimes.
Grabbing a slice of that online grocery pie.
It's just a completely holistic approach, isn't it? Covering every angle of modern convenience, in-store delivered meals, dietary plans.
It really is. Which brings us to what I'd say is the absolute cornerstone of their success. A massive competitive advantage. Their franchise model.
Ah, yes, the franchise system.
It's not just how they're structured. It's a strategic weapon. About 99% of their, 11,000 plus stores, they're run by roughly 10,000 independent entrepreneurs. This asset-light, fully franchised approach is incredibly powerful. It lets them expand super fast, penetrate the market deeply, all without Żabka itself having to pour huge amounts of capital into buying property and running stores directly.
Just imagine the cost if they owned all 11,000.
Exactly.
Yeah.
And for someone wanting to become a franchisee, the barrier to entry is surprisingly low. An entrepreneur needs an initial down payment of only around PLN 5,000. That's mostly for the till system, initial setup stuff.
5,000 zloty. That's barely more than the monthly minimum wage, right?
Pretty much. So it makes becoming a business owner really accessible for a lot of people. They get to be their own boss, but with significant corporate backup.
Okay, but the big question then is control, isn't it? How do they keep standards high and maintain consistency across 10,000 independent owners? That seems like a huge challenge.
That's the really fascinating part. While the franchisees are legally independent, Żabka Group keeps incredibly tight strategic and operational control over the critical stuff. Żabka holds the leases for all the stores. They choose the locations.
Ah, okay, so they control the real estate.
Yes. They design the store layouts, manage the entire supply chain, dictate the product range in every store, and they implement data-driven pricing and promotions network-wide.
So the franchisee is running the store day to day, but within very strict parameters set by Żabka.
Precisely. It allows them to get the best of both worlds. The speed and capital efficiency of franchising, but with the brand consistency and quality control of a corporate chain. And crucially, if a franchise isn't performing or sticking to the rules, Żabka can replace them. That protects the whole network.
Right. Quality control mechanism.
But the real genius, perhaps, of this franchise structure goes beyond just efficiency. It acts as a powerful regulatory moat.
The Sunday trading ban.
Exactly. Poland has that ban stopping most big retailers, supermarkets, discounters from opening on Sundays. But there's a key legal loophole. Stores where the owner or their family is physically working are exempt.
And because Żabka stores are run by these independent franchisees,
they almost all qualify, meaning Żabka can stay open and rake in revenue on Sundays when their biggest competitors are forced to close.
Wow, that's huge.
It's absolutely fundamental to their dominance and convenience. He gives them a massive chunk of the weekend market share, an advantage competitors with different models just can't replicate.
Okay, so the franchise model is key. The regulatory angle is huge. What about tech? You mentioned Żabka Future. Their embrace of technology and digital transformation feels core, not just an add-on.
Oh, completely. It's woven right into the fabric of the business. They're becoming a data company as much as a retailer. And the heart of that is the Żabka mobile app.
Right, the app. How many users did you say?
Over 9.7 million active users. It's more than just loyalty points. It's the digital front door to the whole Żabka world. It is personalized promotions, loyalty, integrates all their digital services, ordering, payments. But maybe the most important thing, it's a powerful tool for collecting really granular, real-time data on what customers are doing, what they prefer, how they shop.
And that data feeds back into the business.
Exactly, which leads to the next point. Here's where it gets really interesting. They're not just selling stuff. They're becoming this data-driven machine that understands, predicts, even monetizes consumer behavior at a hyper-local level. That creates a really powerful competitive feedback loop. They use AI-powered decision-making everywhere. Take site selection for new stores. They have a proprietary AI that crunches data on millions of potential addresses in Poland, looking at hundreds of KPIs. Geospatial data, traffic flows, local wealth levels, competitor locations. Everything.
All to find the absolute best spot for the next Żabka.
Precisely. And to make sure they don't put stores too close together, minimizing cannibalization, it maximizes the potential of every single new opening. And that data-driven approach extends to pricing too, and promotions. They can tailor offers for specific stores based on the local customer base.
Hyper-local optimization.
You got it. And then there's the really cutting-edge stuff, format innovation like Żabka Nano.
Yeah, unmanned stores.
Yeah, fully autonomous, cashierless stores. Żabka runs one of the largest networks of these in Europe, actually. They operate 247, no staff needed on site. This lets them put stores in places a traditional shop just wouldn't work.
Like where?
Think big office buildings, busy train stations or airports, university campuses, high traffic spots. Customers just grab items and walk out. Computer vision and sensors handle the payment automatically.
Wow. That's pushing the boundaries.
It is. It's strategic, capturing every possible convenience moment, and it's also a live lab for future retail tech.
Market forces, tailwinds, headwinds, and a unique niche.
Okay, let's zoom out a bit now. We've looked inside Żabka, but what about the world it operates in, the Polish retail market context?
Right, essential context. We're talking about the biggest food and beverage market in Central and Eastern Europe, almost 40 million consumers. And it's a really dynamic, fast-moving, and frankly, fiercely competitive market, shaped by unique consumer habits, specific regulations, and a pretty strong economy. Understanding that backdrop is crucial.
So what's working for them? What are the tailwinds helping Żabka?
Several big ones. First, really favorable shifts in consumer behavior. Polish consumers are increasingly doing little and often shopping, moving away from the big weekly supermarket trip.
Why is that?
Busy lifestyles, more people in cities, longer working hours on average compared to Western Europe, smaller households, and crucially, a real desire to save time. There was a survey in 2024 found 34% of Poles are willing to pay more for things that save them time.
And that plays right into Żabka's hands, doesn't it? The convenience factor.
Absolutely. Willingness to pay for convenience is core to their whole value proposition. It's a massive growth driver for them. Second tailwind, urbanization and positive demographics. More people moving to cities means more dense population centers, perfect territory for convenience stores. And Żabka's target customer, young, active, urban, is a growing segment in Poland.
So the underlying trends are favorable.
Very much so. And third, Poland has a generally strong economic outlook. The economy's been resilient, growing faster than most of Europe. Projections are solid GDP growth around 2.5% in 2024, maybe close to 4% in 2025.
Which means more disposable income.
Exactly. Rising incomes, strong retail sales. It creates a really positive environment for consumer businesses like Żabka.
Okay, so strong tailwinds, but it can't all be easy. What are the headwinds? The challenges they face?
No, definitely not all smooth sailing. Big challenges, too. One of the biggest is intense price competition.
The discounters.
Yeah, the Polish market is known for fierce price wars, mainly led by Biedronka. They have something like 22% of the total market, and Lidl around 11%. These guys are super aggressive on price. It sets a kind of ceiling for the whole market, makes consumers very price sensitive.
So even though Żabka sells convenience, they can't ignore price.
They can't completely ignore it, no. For everyday groceries, price is still key for most Poles. Żabka operates within that reality.
What else? You mentioned regulation before.
Right, regulatory uncertainty. This is maybe the single biggest external risk factor, that Sunday trading ban we talked about.
The one that gives them a huge advantage.
Exactly. It's constantly being debated politically. There are ongoing talks about repealing it or changing it significantly. If large stores were suddenly allowed to open on Sundays, it would be a massive blow to Ubka. It wipes out a key differentiator, puts them head-to-head with the big guys on their best day.
A seismic shift, potentially.
Essentially, yes. And finally, like everywhere else, inflationary and cost pressures. Inflation, even if it's easing, eats into people's spending power, makes them even more price sensitive. At the same time, costs for retailers are up. Energy, logistics, and especially labor costs in Poland have been rising. Squeezes margins if you can't pass it all on.
Yeah, so a complex mix of forces acting on them.
Very much so. And it's interesting to compare Poland to other European markets. You see similar trends globally, smaller urban stores popping up everywhere, but Poland is distinct. Those longer average working hours really emphasize the need for time saving. Convenience is maybe even more valuable there. Plus, Poland's stronger growth forecasts suggest more runway for expansion compared to slower, more saturated Western European markets.
And the convenience driver is twofold, you said. Time and location.
Exactly. Żabka isn't just about a fast transaction, it's about extreme proximity. Their goal is a store within 500 meters of 17 million Poles. That creates this mental monopoly for immediate needs.
Like, I need a drink now, Żabka's the obvious closest choice.
Precisely. For that quick top-up, that impulse buy, the extra cost compared to a big supermarket is an acceptable trade-off for the sheer convenience. Time saved is worth more than the small price difference.
You also had an interesting point about how the discounters, their main competitors, actually help Żabka indirectly.
Yeah, it sounds counterintuitive, right? But think about it. Biedronka, Lidl, they dominate the big weekly shop, the planned grocery haul.
Right.
But once you've done that big shop, what are your other shopping trips during the week? They're for smaller baskets, impulse buys, forgotten items, the top-up mission.
Oh.
And Żabka's entire model small store everywhere focused on immediate consumption is perfectly designed for that mission. The big discounter model, driving there, navigating huge aisles, it's not suited for just grabbing one or two things quickly.
So the discounters capture one type of shopping, leaving the other type wide open for Żabka.
Exactly. Paradoxically, the discounter's success reinforces Żabka's niche. They complement each other, in a way.
That's a fascinating dynamic. So, given all that, how does Żabka actually stack up competitively? How do they stand out in this crowded market?
Well, they've carved out an incredibly dominant, almost insulated position in their chosen segment. Remember, the overall Polish food market is fragmented. You've got the discounters, Biedronka, Lidl leading the pack overall. Then the traditional supermarket, supermarkets, Polska, Auktion, Carrefour, Kaufland, many losing share. And then direct convenience competitors like Carrefour Express, Spar Express. But Żabka has basically consolidated that space over the years. They bought some rivals.
So they cleared the field in direct convenience.
Pretty much. And the market share numbers tell the story. Overall food retail, Żabka share is small, less than 5%. Biedronka's way ahead at 22%, but that's misleading. Żabka isn't trying to win the whole grocery market. Within their directly addressable market, the bits they actually target, their share jumps to over 20%.
Okay, much bigger there.
And here's the kicker. Within the specific modern convenience segment, so excluding traditional mom-and-pop shops, Żabka's share is over 90%.
90%.
90% plus. It's essentially a near monopoly in their chosen niche. Recent data from Q3 2024 showed that even as the broader small store category lost a bit of ground, Żabka grew its share within that category to 18.6%. They're taking share from older, less efficient grocers.
That is astonishing dominance. They must have built some serious defenses. What are their moats? How do they keep competitors out?
Absolutely. It's not luck. They have several powerful interlocking moats. First, unmatched scale and network density. Over 11,000 stores. That footprint is just immense. Creates visibility, convenience, huge economies of scale. Impossible for a newbie to replicate quickly.
The sheer number of stores.
Second, that capital-light, regulated advantaged franchise model. We covered this, but it's crucial. Fast, efficient growth, plus that Sunday trading ban protection. A massive structural advantage.
Right, the franchise moat.
Third, powerful brand equity. Żabka is one of Poland's most recognized brands. 90% awareness, it's synonymous with convenience that builds huge loyalty, lowers customer acquisition costs.
People just know Żabka means quick and easy.
Fourth, superior logistics and supply chain. Their own network, 8 distribution centers, 1 fully automated, 19 cross-docking hubs. It's sophisticated. It allows frequent, reliable deliveries to thousands of small stores, ensures high stock levels, fresh products vital for convenience, a huge operational feat.
Hard to copy that efficiency.
And finally, data and technology leadership. Using AI for site selection, using the Żabka app data for personalized pricing and marketing gives them a significant edge. These 5 modes aren't separate, they reinforce each other. Creates a really formidable defensive position.
Incredible. Now, it's interesting to compare them briefly to Dino Polska, both growing fast in Poland, but different segments.
It's a really important comparison, actually. You ask, why compare them if they're so different?
Yep.
It's because they're both prime examples of how to win big by focusing intensely on distinct complementary parts of the market, stealing share from older formats. Żabka, urban, time-poor, convenience-focused. Dino, more suburban small town, families, bigger planned shops, often car-based.
Different needs, different models.
Totally. So comparing them, growth. Żabka's had a higher revenue GAGR recently, 25.9% from 21-23. Analyst forecasts also put Żabka's EBIT growth slightly ahead of Dino's going forward. Profitability. Underlying operating margins are actually quite similar. Both hover around 7.5% adjusted EBIT margin. Strong models.
Okay.
Capital efficiency. Żabka's ROCE is strong, around 27%. Excellent, but Dino's is even higher, partly because Dino owns more of its stores, which boosts return on that capital.
Right. Different asset structures.
But the biggest difference, the key one, is leverage debt. Because of its private equity history, Żabka's net debt to adjusted EBITDA was 3.9x at end of 2023.
That sounds quite high.
It is, especially compared to Dino Polska, which is incredibly conservative at just 0.7x.
Wow, huge difference.
Massive. It highlights their completely different financial strategies. Żabka uses debt to fuel growth and boost equity returns. Dino is much more cautious, different risk profiles.
The financial pulse and future ambitions.
All right, let's switch gears then and really dive into the financial pulse of Żabka. You mentioned the growth, exceptional track record, rapid, profitable. What do the actual numbers show us?
Absolutely. Looking at their historical financials, the top-line growth is just powerful. Consolidated revenues grew as a CAGR over 20% recently, from PLN 12.5 billion in 2021 to an estimated PLN 23.8 billion in 2024. That's huge expansion.
And profitability kept pace.
At the operational level, yes. Adjusted EBITDA, that core measure of cash flow, grew nearly 24% in 2024, hitting PLN 3.5 billion. Their operating margin's been stable, around 7%, and the adjusted EBITDA margin actually ticked up slightly in 2024 to 12.8%. So the core business is very healthy, improving even.
But you mentioned a nuance with net profit.
Right. The net profit margins are much thinner, around 2.4% recently, and that's almost entirely down to the big interest payments on their large debt pile, that private equity legacy again.
Yeah.
But even with that, the actual net income figure jumped significantly in 2024, up 76.5% to over PLN 624 million.
Ow.
So strong, absolute bottom line improvement.
Okay, impressive top line and operational growth. But what's really driving it? Is it just opening loads of new stores, or is the performance of existing stores strong too?
It's a very effective combination of both, actually. They feed each other. First, you've got robust like-for-like LFL sales growth. That's measuring how existing stores are doing. It was a healthy 8.3% in FY 2024, still strong at 6.0% in Q1 2025. That tells you there's strong underlying demand, good merchandising, successful new products and services working in the existing stores.
So the established stores are pulling their weight.
But the main engine of that huge top-line growth is undeniably aggressive network expansion. They opened over 1,100 new stores in 2024 alone. That pace is just incredible.
Over 1,000 new stores a year?
Yeah. And crucially, the efficiency of that expansion has improved dramatically. The average payback period for a new store, how long it takes to earn back the initial investment, went from 20 months back in 2017 down to just 12 months for stores opened in 2023.
Only 12 months to get their money back.
Yeah.
Wow.
It's remarkable. Driven largely by that AI site selection and optimized store models. It means they recycle capital incredibly fast, get the investment back quick, reinvest it immediately into more stores, creates this accelerating self-funding growth cycle, a virtuous loop.
Okay, growing fast, profitably, super efficient store rollouts. But what about their overall financial health? Cash flow, balance sheet strength. Can they sustain this ambition?
Yeah, their cash flow profile looks pretty healthy for a fast-growing retailer. They generate strong cash from operations PLN 3.55 billion in the last 12 months. That's the bedrock. And they benefit from that negative working capital cycle.
Meaning they sell stuff before they pay suppliers?
Exactly.
Okay.
Highly efficient. Minimizes cash tied up in inventory, frees it up for reinvestment. In 2024, they generated PLN 1.53 billion in free cash flow.
Yeah.
FCF. That's cash left after all expenses and investments. Shows they can fund a good chunk of their growth internally.
Okay, strong cash generation. But the balance sheet, you mentioned the debt.
Right. The balance sheet clearly shows that LBO history. Total debt around PLN 9.65 billion at end of 2023. That includes financial debt plus all the lease liabilities for the stores. That leads to a high debt-to-equity ratio of 7.3 and that net debt to adjusted EBITDA of 3.9x.
Which is quite leveraged, as you said, compared to Dino.
Very leveraged. It's the classic post-PE profile. Strong operations, strong cash flow, but high debt means big interest payments eat into net profit. Leverage boosts return on equity, sure, but it adds financial risk, makes them sensitive to interest rates, limits flexibility. Deleveraging is clearly a priority alongside growth.
Got it. And what about returns on capital? You mentioned ROE looked high because of debt.
Exactly. Return on equity, ROE, is exceptional at over 51%, but that's inflated by leverage. A better measure of underlying profitability, stripping out the levered effect, is return on invested capital, ROIC. That stands at a healthy 9.78%.
So still generating decent returns on the total capital used.
Yes, it indicates the core business is productive and uses its combined debt and equity effectively.
Okay, that paints a clear financial picture. So, looking ahead, what's the actual plan? How do they keep this machine going and hit their ambitious targets? What's the growth strategy from here?
They've laid out a really ambitious multi-pronged strategy. The goal is to more than double sales to end customers between 2023 and 2028.
Double sales? How?
Well, the core engine is still network expansion in Poland. Keep opening 1,000 plus new stores a year. Even with 11,000 stores, they believe there's significant white space left. Their AI identifies potential for around 14,500 stores in Poland by 2028.
Still room to grow domestically then?
They certainly think so, and their data supports it. Then there's international expansion. Romania is the big test right now. They bought a local distributor, DDRIM, in 2023. Now they're rolling out stores under the Peru. Brand target was 200 stores by end of 2024. It's about proving the Polish playbook can work elsewhere. Success there could unlock bigger things internationally.
A critical test case.
Definitely. Pillar number 3 is the digital and omni-channel strategy. Big push here. Aiming to grow revenue from their digital customer offering, DCO, 5-fold by 2028.
5 times, driven by those acquisitions like MexFit.
Largely, yes.
Yeah.
MaxFit, Daily.pl, tapping into health, wellness, ultra-convenience trends, integrating these platforms to capture customers across all occasions in-store, delivered meals, dietary plans.
Deepening that customer relationship.
Exactly. And what's really interesting is this sort of barbell approach they seem to be taking.
Barbell, how so?
You've got the low-risk, proven, cash-generating core store expansion in Poland on one end. That then funds the higher-risk, more venture-style bets on the other end, the digital stuff, international expansion. It's a balanced portfolio.
Makes sense. Spreading the risk.
Right. And finally, they're constantly pursuing adjacency and format innovation, expanding the high-margin quick meal solutions, the Żabka Cafe concept, developing new formats like Żabka Nano, cashierless, even exploring Żabka Drive for motorists. They're even looking into things like financial services, just relentlessly seeking new ways to add convenience and revenue streams. It's a very comprehensive roadmap.
Risks, valuation, and the investment thesis.
Okay, that is certainly an ambitious plan, hitting growth from multiple angles.
Yeah.
But every story like this has its potential downsides, its risks. What are the big ones for Żabka? What could trip them up?
Yeah, absolutely. Despite the strengths, there are significant risks. On the business and operational side, there's that franchise model dependency. They had a 16% franchisee turnover in 2023. While they manage it, high churn can still cause disruption, hurt the brand, increase costs.
Keeping 10,000 entrepreneurs happy and effective is a challenge.
It is. There's also supply chain risk. That centralized network is efficient, but it's also a concentration risk. A major problem at a key distribution center could impact thousands of stores.
Like putting all your eggs in a few baskets.
A bit, yeah. And being so tech-focused makes them a target for cybersecurity threats. A breach could be damaging operationally and reputationally. Then you have competitive and market risks. That intense competition, especially price pressure from discounters, is always there. Could squeeze margins. And there's potential macroeconomic sensitivity. Their impulse buy heavy product mix might be more vulnerable if consumers really tighten their belts in a downturn.
People cut back on treats first, maybe.
Potentially, yeah. Fewer impulse buys, maybe choosing cheaper options.
But you flagged the regulatory and legal risks as perhaps the most serious. Here's where it gets really interesting, right? These aren't minor bumps. They could fundamentally change everything.
Absolutely right. This category holds the biggest potential game changers, given Żabka's specific model in Poland. The Sunday trading ban exemption is number 1. It's the bedrock of a key competitive advantage and a lot of their profit. The political debate around repealing it is very real if that exemption goes.
It opens the floodgates to Sunday competition from discounters.
Exactly. Direct competition on their most lucrative day. It would almost certainly mean severe margin pressure. It's a huge external risk.
Outside their control, really.
Largely, yes. And equally critical, potentially even more so, is the legal status of franchisees. There's a non-zero risk that courts or regulators could challenge the independent owner status and try to reclassify them as employees.
If that happened.
It would be catastrophic for the current model.
Yeah.
Suddenly, UBCA would face massive costs, payroll taxes, social security, benefits for 10,000 plus operators. It basically dismantles the whole asset-light, low-cost structure, hugely impacts profitability. Management works hard to structure things to avoid this, but the risk exists externally.
Two potentially massive regulatory legal swords hanging over them.
Pretty much. Then, finally, the financial risks. We've discussed the high financial leverage over PLN, $9 billion in debt, makes them sensitive to interest rates, limits flexibility. And there's the share overhang, this big private equity stake CVC with 41%, Partners Group 13% post-IPO.
They'll want to sell eventually, right?
Exactly. As they exit over time, selling large blocks of shares can put downward pressure on the stock price just due to supply, regardless of how the company's doing. Now, UBCA has strategies to mitigate all these risks, but they are significant and need watching.
Definitely a lot to consider on the risk side. So bringing it all together, the growth, the moats, the risks, what does the market actually think UBCA is worth? How's the valuation look?
Yeah, valuation is tricky, requires looking at it a few ways. On a trailing 12-month basis, the price-to-earnings PE ratio is around 36x.
36x. That sounds high compared to the overall Polish market.
It is. Very high premium. The Polish market PE is often under 12x. Other metrics. EV sales around 1.24x. EV/EBITDA typically in the 9.5x to 12.9x range. Now, comparing to peers is revealing. Against Polish peers like Dino Polska, the EV/EBITDA multiple is similar, suggests the market values their core operations similarly. But UBCA has that much higher PE ratio. Why?
Because the debt means higher interest costs, lower net income for the same operating profit.
Exactly. So the PE looks higher. The market seems to be baking in a discount for the higher leverage and maybe those regulatory risks too. Raises an important question, is that premium justified? Compared to mature European food retailers like Ahold Delhaize or Tesco, UBCA trades at a big premium on all metrics. But that makes sense. UBCA's growing way faster.
Apples and oranges, really.
Pretty much. But compared to global convenience peers like Couche-Tard in Canada or 7 & I in Japan, and UBCA's valuation looks much more reasonable, sometimes even a bit cheaper. Suggests it's valued broadly in line with other high-growth global convenience players.
Okay, so the context matters. What about valuation relative to its growth prospects?
Right, that's where the PEG ratio helps. Price earnings to growth. UBCA's PEG is around 0.89. Generally, a PEG below 1.0 suggests a stock might be reasonably priced given its expected growth. You're potentially not overpaying for the future earnings. And analyst forecasts back this up. They expect UBCA's earnings to grow around 36% annually over the next 3 years, way higher than the Polish market average of 5%. That strong growth outlook is key to justifying the premium PE.
So let's synthesize all of this. Putting it all together, the model, the dominance, the financials, the risks, the valuation, what's the core investment case? The bull versus the bear.
Okay, let's lay it out. The bull case is built on unquestioned market leadership, over 90% share in modern convenience in Poland, a growing niche in a big market, a powerful, scalable business model, that asset-light franchise, the 12-month payback, the Sunday trading mode, a proven multi-level growth strategy, 1,000 plus stores a year, international steps, digital QMS expansion, clear path to doubling sales, superior operational execution, fantastic logistics, data tech leadership, optimizing everything, and experienced leadership. The CEO knows this market inside out, came from their biggest competitor.
Okay, that's compelling. Now the bear case.
The bear case centers on those big vulnerabilities, mostly external, number 1 and 2. The existential regulatory legal risks, repeal of the Sunday trading ban, or reclassification of franchisees as employees. Either would be hugely damaging.
The two big what ifs.
Exactly. Then the high financial leverage. Makes them fragile, sensitive to interest rates. The elevated valuation doesn't leave much room for error, prices and a lot of success already. And finally, that future share supply, the overhang from PE exits potentially capping the price.
So a real tension between operational strength and external financial risks.
Precisely. Therefore, the risk-reward profile is, well, it's skewed. It's a high-growth, high-risk proposition. The potential reward from successful execution is significant growth. The operational quality is there, but the risks are substantial, especially those external black swan regulatory legal ones. And the valuation seems to demand flawless execution and assumes the favorable regulations continue. So you're paying a premium for a great growth story, but taking on some low probability, high impact risks.
That's a very clear summary. So if you, our listener, wanted to keep track of how this fascinating story unfolds, what are the key things to watch? Operationally, keep an eye on LFL sales growth, shows underlying health, the pace of new store openings in Poland and Romania. The franchise churn rate, rising, could be a warning sign. And digital offering revenue growth. Is the omnichannel plan working? Financially, track net debt-adjusted EBITDA. Are they deleveraging? And watch margin evolution. Can they protect profitability? Critically, on the regulatory legal front, any serious legislative talk on the Sunday trading ban or major court cases on franchise status, these are vital. And finally, shareholder activity. Watch for CDC Partners Group share sales after lockups expire. Could affect the stock price. Żabka has built this incredible machine, this convenience empire, by brilliantly using a unique regulatory loophole and just deeply understanding what convenience means to people today. But as tech keeps changing, as regulations shift, how agile does a giant like this need to be to avoid becoming a victim of its own success or losing that key edge? And maybe the biggest question, how much can even the best innovation really protect you if a core regulatory pillar of your business gets pulled away? Something to think about. Thank you for joining us on this deep dive into Żabka Group. We hope you gain some valuable insights and maybe even look at your own local convenience stores with fresh eyes, seeing the complex business humming away beneath the surface.
Yeah, absolutely. Knowledge is most useful when you understand it and can apply it, right? Looking beneath the headlines, connecting those dots like we tried to do today with Żabka, it helps you see the bigger picture, especially in this world of constant information overload. We really appreciate you diving in with us today, and we look forward to the next deep dive.